Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We are broadcast locally at Radio Northern Beaches and around the country on Community Radio Network. I'm really pleased to welcome back to the microphone Justin Bott from Services Australia. You may know them as Centrelink and a whole bunch of other names, but we're not going to go into that today. But look, 20th of March, Justin, has come and gone, and some of you out there may notice that there's an increased rate in your pension. And that's because Services Australia has applied the increases to payments, including pensions, which have been indexed by the Department of Social Services, like they do on the 20th of March and 20th of September each year. Now, what the rates are and where they go up and down, assets, limits, and the like. Look, Justin Bott has been on our show before. He's the Community Information Officer for Services Australia, and he's joining us today to talk us through all of these changes that has just happened. So we're going to dive into these now. And so, Justin, hi and welcome.
G'day, Ray. Thank you so much for having me. It's great to be back on the show.
Wonderful. So look, 20th of March has come and gone, and that means the pension has just increased due to indexation. So I think the best thing to start off with is what are the new rates?
Absolutely. So if you're a single person, the pension rate was $1,096.70 a fortnight. It's now $1,116.30 a fortnight, which is an increase of $19.60. If you remember a couple, it's $826.70 a fortnight. That's what it was. That's each. It's now $841.40 a fortnight each, which means it's gone up by $14.70 a fortnight each. Mm-hmm. And when you increase the pension, what that also means is that you're going to increase the cutoff points for the pension. So where the income and the assets actually get to a point where you're not eligible for, you can't get any payments anymore.
Now, so everything starts gradating up.
Yes, when you move the base point, you're pushing out the end points as well. But it is worth also mentioning very quickly, and a lot of pensioners who've been through this process beforehand know this, that the first payment that you get after the 20th of March is actually a hybrid payment. So it will be a few days at the old rate and then a few days at the new rate. So it'll be a combination of the two into one. And it won't be until your second fortnightly pension payment after the 20th of March that you'll actually see what your true new rate is going to be.
Okay, so it's a bit of a part of the old, part of the new, and then the fortnight later you get the full whack.
That's exactly right, yep.
Wonderful, wonderful. So with that regard, look, when we look at these new limits, let's start with the basics. So when we're applying for a pension, Services Australia looks at our income and our assets to work out what we actually might be eligible for. So how does this actually work, Justin?
Well, the first thing we've got to check is that you actually are eligible for the pension in the first place. So what we're going to be looking at is your basic pension eligibility factors. Are you over age pension age? Do you meet our residency requirements? And if you meet both of those, then we've got to work out, well, how much pension can you get? And that's going to be determined by your income and your assets, basically what you earn and what you own. So what we do is we're going to look at your eligibility under the two separate tests. The income test is one and the assets test is the other. And we apply both of those tests to every pensioner and work out how much you're eligible for under the income test, work out how much you're eligible for under the assets test, and then whichever one's going to pay you the lower rate is the one that we use. So, for example, say you're eligible for a pension of $750 a fortnight because of your income, but only $400 a fortnight because of your assets, then we're going to be paying you $400 a fortnight as your ongoing pension payment.
Sounds logical. I guess some people might sit there and argue and say, but hang on, I want the 750, not the 400, right?
Oh, let's just say that's the, that's been the pension policy since there has been an income and assets test in existence. So we're talking years, so that's the way that it goes. But that's government policy. That's how we make the payments go out to people.
Cool. So look, you sent me a few links to have a look at. And ladies and gentlemen, one of the things that we always like doing on Dollars and Making Sense, we love freebies. So we'll put a couple of links in our blogs. But I think one of the really nice things that when I look through the Services Australia website, I've got to say you've demystified and it's a lot of very plain speak. So let's talk a little bit about asset types. So what are the kind of things that Services Australia will look at and say, this is an asset and this is not, for example, when they're counting it towards a pension?
For sure. So an asset basically is something that you own. That makes it an asset. And in the reality, it's actually easier to look at the ones that we don't count rather than
That's a
list the
good
ones
point.
that we
Yeah.
do. So the
Okay.
biggest asset that Services Australia does not count in most circumstances is the family home. So for most people, the family home is an exempt asset, doesn't count towards your eligibility for payments. Some other ones that we look at are superannuation for people who are under age pension age, as long as it stays in super, so in that accumulation stage.
And accumulation, not in pension phase.
Not in pension phase. Pension phase is in effect no longer in super, it's now in payment or
Mm-hmm.
drawdown. That makes it count. So if you're over age pension age and your partner isn't, then your partner's super, while it's still in accumulation, won't count. But if your partner moves to super, puts it into a bank account, or does basically anything else with it, they're pretty much making it accessible because it's no longer sitting in accumulation. So super in age, while it's in age pension age, is an exempt asset. Funeral bonds and fully prepaid funerals are also exempt assets, don't count towards your pension.
Oh, that's good. So people are saving up for that kind of thing will know that that means that that's not going to count against them, right?
No, we don't talk very much about funeral bonds or fully prepaid funerals. And you're right. First of all, it doesn't count as an asset for Services Australia. But something like a fully prepaid funeral, for example, where you've pretty much made all the decisions, means that you're also not expecting the family to have to make a whole lot of decisions at a time when the family may not really be equipped to make those sort of decisions. So you're making their life easier as well. So there are other benefits from that one. Refundable accommodation deposits that you pay to go into an aged care facility does not count as an asset for your pension, but does count as an asset when it comes to the means tested fee for the aged care facility. So they're not treated the same from one to the other. And some, certainly old ones, but some retirement income stream products may have full or partial exemption from the assets test, depending. Like your standard account-based pension is a fully accessible, the full asset value is counted, but there are some really old annuities and some new products that have come out that have got a partial assets test exemption. But if you're playing in that sort of world, you're really looking for financial advice before you go into those sorts of things.
I was going to say, look, I one of my dear friends, her mum's just selling their family or her family home to go into care. She unfortunately has dementia. And I must say, even as somebody, I hold an AFSL, I'm an investment manager. When I start looking over the rules and the regulations that pertain to aged care and selling a family home, it's like, wow, this is an area that I would certainly commend to pretty well 99.9% of the population. Go and see a professional, because it's really a world that's quite apart from pretty much everything. And pensions can still be drawn, isn't that right, Justin? But there are certain rules, right?
Yeah, there are. It is complicated because you're looking at actually, certainly if you're looking at an age pension eligibility at the same time, the rules that might work for one don't necessarily work for both. So, or there are implications for both, depending.
Yeah.
And so it's often not necessarily the case of there is one strategy that is the best strategy, but it's the best of a range. So you're talking about seeing professionals. One of the people that I would add to that group is Services Australia's aged care specialist officers.
Of course.
So we have a dedicated workforce, they're aged care specialist officers, and they are a free and impartial aged care expert. So their job is to help explain the complete ins and outs of aged care, but not just, again, about aged care. What does it mean for my pension rate? More importantly, what does it mean for the fortnightly dollar? What does it mean for how much I'm going to be living off every fortnight if we're talking about refundable accommodation deposits and basic daily fees and means tested fees and all the sorts of things that go with aged care? So I would recommend everybody have a look at our website, search for the aged care specialist officers. There may be one in your local office that you'll be able to make an appointment with, and otherwise, so certainly for Northern Beaches there is at the Brookvale office. But also you may be, if required, if you're outside of that, you might be able to just give us a call, speak to one over the phone, do a video conference with them and actually still see them face to face.
Oh, so you're doing video calls now for your clients as well. That's brilliant.
From some of our specialist services, we are, yeah.
And again, look, we love free here on Dollars and Making Sense, ladies and gents. And I think this is really, really important. That I know it sounds very cliche, but when you hear the term "we're from the government and we're here to help you," it's not a joke. We're not doing a line in utopia. It is actually real. And one of the things, Justin, I've been really pleased that you've been on the show is highlighting some of these excellent free resources. Now, I've got a good, I've got a decent broadband connection, so I can access my web services. But not everybody around the country has access to that. But they want to be able to know, for example, that they can pick up the phone. There may be a bit of a wait time, but it's essential, particularly around this aged care facility and pensions. And if somebody's going into aged care facilities, there is a lot of complexity there, and being able to, rather than necessarily going to a financial planner, starting from a free resource, I think I don't want to venture a number, but I think a good number of people may be able to be satisfied and get all the information they need without necessarily paying. And again, a financial planner, I know many, and they're good people. The vast majority are great people, but they need to charge for their service. It's not something that they can do for free. But a good starting point is to go to Services Australia.
Yeah, we absolutely, because we don't consider ourselves to be in competition with financial planners, either the Services Australia's Financial Information Service or our aged care specialist offices, because we actually can't do what they do. So we don't give advice, we don't recommend products, we don't recommend services, and we can't purchase anything for you. But what we can do is explain, here are your 4 different choices. Here are the implications for those 4 different choices, what would mean for your fees, what would mean for your pension, what does it mean for your dollar at the end of the day, how much is going into your pocket. And these are your options. Now, that may mean that you need to then engage with professionals to make that happen.
After that.
But we will certainly explain why the professional may be able to help you, what might be useful having that professional join you. So what they can also do on your behalf and where their limitations are as well. But again, it's a free service. You can call My Aged Care is the website that you go to when it comes to aged care. That's the website you go to, myagedcare.gov.au. There's also a phone number there that you can ring to speak to My Aged Care over the phone. If you go to our website and look up aged care specialist offices, it's a dedicated phone number to speak to one of them and make an appointment and sit down or do that video conferencing. So highly recommend it. It's an hour and a half. They've got an hour and a half time for you, so it's lots of time.
Wow.
It's not a one-off interview either if you need to, because it may be part of a journey. I might have the first part where we're looking at home-based care and we have to work through all the ins and outs of home-based care. And then a year down the track, unfortunately, things have gone a little bit worse, and now we're literally looking at having to go into a residential facility. Completely different story, completely different financial position, and the family home and all that sort of stuff coming into account. I can go back and see my aged care specialist officer, and I can have that chat again. So, highly recommend it. Go to the website, servicesaustralia.gov.au, and look them up.
Wonderful. Look, it's time for a break here on Dollars and Making here with Justin Bott, Community Information Officer from Services Australia. We're going to go for a short break and be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm Ray Trevisan, your host, and with me this week is Justin Bott from Services Australia. And we are talking about pensions. They've gone up, about limits, and about assets and income tests. Now, look, when we're talking about valuing assets, obviously, the punter can't come along and say, well, look, I'm valuing my house at $10,000 and, obviously I'm going to get a full pension. So that doesn't work. So how are assets actually valued?
Yeah, so in most cases, the asset value is actually what they would be worth if you put them on the market. So, for example, bank accounts, we're going to know what's the balance of your bank accounts right at the moment. With the account-based pensions, again, what's the balance of your account-based pension at this point? With shares and with managed funds, we're going to ask for the number of shares that you own and the number of units that you have in those managed funds. And they themselves actually get revalued on the 20th of March and 20th September automatically as well, the number of units and shares, which is why we don't want to know how much your shares are worth. We want to know how many shares you have. So from Services Australia's perspective, here's just a tip for punters. If your shares go up and down in value, you actually don't need to tell us about that. We don't worry about that. We automatically revalue on the 20th of March, 20th September. You can get it changed if you want to, but you don't have to. But you do have to tell us if the number of shares you own has changed or the number of units in a managed investment has changed. So if you bought some, sold some, been given some as part of a dividend reinvestment scheme, for example, then that is actually something you need to tell us because the number of those shares has changed.
Has gone up.
Or down if you sell, by the way. So, yeah, they're the main ones. The other big ones, obviously, are something like real estate. With real estate, we are looking at realistically what would you get if you put that on the market today. It's not the original sales price. It's not your insurance value. It's not whatever else system you might be using. It would be if I sold that in the market right now, how much would I get for that? And the other big one that causes people a lot of thought, and it's really quite easy, is things like household contents and personal effects in your cars. And they may spend a lot of time on this and they really don't need to. So again, for a car, if you were going to sell your car, not sell it as new, but if you were just going to sell your car, realistically, how much you're going to get for it. And for home and contents, what we're talking about here is garage sale value. If I put my life on the lawn and somebody was going to buy it, how much am I realistically going to get for that? So my entire, the CD collection that I think is worth thousands and thousands, the whole lot goes for 50 cents a CD or something like that, if people even buy it nowadays.
I must say, when years and years ago, when my kids were much older, I was eligible for the family benefit. And so we had this question about family assets. And the lady on the phone from Services Australia said, look, really, it's not worth a lot. You might think it is, and it may hold a lot of emotional value to you. But from a Centrelink perspective, we don't value it very much because, as you rightly say, put it out on the street and try and do the garage sale these days, you're going to get pennies in the dollar. It really is not all that much. So I think from a goods and chattels perspective, we're not talking an awful amount.
So it's not, you may have stuff in your home that is particularly valuable, and that's the only place that it shows up. If I happen to have a Picasso on the wall, then that's home and contents. And yes, that's not only for $10,000. But for most of us, it's just going to be a few $1,000s covering the whole lot. It doesn't require a lot of thought process into it because realistically, we're going to take your word for it. Importantly, don't do insurance value. Don't do new for old because you're just going to be creating a value of asset that's not realistically there.
And you're hurting your own pension eligibility, I guess, in that regard, because you're raising the level of assets you've got. Now, the other thing that I think many people have questions about when it comes to how much of things, you use something called deeming. Can you explain to the listeners what deeming means?
Yeah, so deeming is we're moving now from the assets test to the income test. So it's particularly to do with how we assess income from what we call your financial assets. And when we talk about financial assets, we are talking about things like your shares, bank accounts, managed investments, loans that you may have made to other people, any excess gifting that you've done over the $10,000 and $30,000 limits that's still sitting on your record. Account-based pensions, all new account-based pensions, they're all deemed financial assets as well. And what it means is that we don't actually care what your bank interest is, what your dividends from your shares are, what your drawdown from your account-based pension is. We don't really want to know. And if you notice on the application, we don't ask you what those figures are because we apply a universal level of income to all of those products. And they're all, from Centrelink perspective, treated exactly the same, regardless of what their income that you're actually receiving from them. So deeming is these fixed interest rates that we apply to these products to determine a set income, a determined income, a deemed income from these investments, regardless of what you're getting. You could be getting more, you could be getting less. From Services Australia, this is what you're getting. And it is, if you're a single person, the first $60,400 that you have is deemed at 0.25%, and everything over that is deemed to be generating an income of 2.25%.
Doesn't sound like a lot at all then.
If you're a member of a couple, it is presently for the first $100,200, it's at 0.25%. And then from that point onwards, it's at 2.25%. Now, those deeming rates were actually fixed until July this year. So 30th of June, they're staying at that level.
Right.
The interest rates have gone up since those rates were fixed, but because the deeming rates were fixed, they stayed at that level. We are yet to find out what happens from the 1st of July. That decision hasn't been made by government. So we'll find out what the
we
deeming
do
rates
know
are
that, yeah, but we do know with stage 3 tax cuts, there's been a fairly major overhaul from the previous government's policy. And so there's a lot more people going to be lining up for tax cuts on the 1st of July, I guess. So look, let's talk a little bit more about investments and the like, because I've got a fascinating question, because I have clients that invest. And so if they've borrowed money to buy an investment, what does Services Australia do there in that regard? So they've borrowed, so they've got a liability, but they also have an asset that's generating income. How do you treat that?
So again, under the assets test, we're looking at basically it's the net value of an asset. And in this case, Services Australia is allowed to reduce the value of an asset by any loans that are secured against that asset. Okay. So we'll use an investment property because that's a nice one, but this also does apply to margin loans for purchasing share portfolios. But we'll use investment property because it's easy. So if I bought an investment property and say I've spent $400,000 to buy that investment property, and I took out a loan of $250,000 that was secured against that investment property solely, then we're able to reduce the value of the $400,000 asset by the $250,000 loan and say that the asset value is $150,000.
Okay.
But considering for a lot of financial perspectives, the biggest asset I have is the family home, which is worth significantly more than the $400,000. The banks may say, well, we want the home to either be the exclusive security because it's absolutely got the ability to cover the mortgage, or at least cover some of the mortgage, so it's secured jointly between both properties.
Right.
Because the family home is an exempt asset, any mortgages secured against the family home don't count because the home doesn't count, so we don't look at that. So if part of or all of the mortgage used to purchase the investment property is covering the exempt asset called the family home, then none of it is going to be used. So they look better. Yeah. If all of the loan is from the family home, then none of it will be able to be used to reduce the value of the property.
That's fascinating.
If part of the loan is secured against the family home and secured against the property, then the same proportions will be used to reduce the value of the investment property asset. So we'll work out how much of the value of the home in comparison to the value of the investment property. We'll then apportion the mortgage based on that same percentages and be able to reduce the value of the investment property by the proportion of the mortgage that's secured against the investment property.
Wow, so that has major impact then, I bet.
So if any other assets are being used to create the ability to borrow the money, then it's not being used securely solely against the investment property. We won't reduce the value of the property by the amount of that asset.
Wow. Okay, that's an interesting point. I'm glad we raised and discussed that, because it's always been an interesting question, because I know banks will want the best possible security, but sometimes I look at the way they use security and I think they're a little heavy-handed, for example. So in the case where you've just mentioned, where they're saying, well, look, we've got security on the investment property, but we want some added security as well. I'm sitting there going, well, hang on, you're killing me doing that, even though, you know, we don't actually need it, because if they're able to reclaim the investment property as security, if the default occurs, that's interesting.
One of the choices that you're going to have, certainly if you're looking at going to apply for a pension and you've still got assets with loans, is where exactly do those loans sit? And is this time to rearrange and refinance and put
Yeah.
things back where they were? Yes, you'd be looking at how much would it improve in the potential pension rate, but also is there going to be costs associated with doing this? Or is it even possible? So you would certainly be looking at having a chat with your bank, and making an appointment with a financial information service officer with us will be a good idea as well, because they
Yep,
can
we've
talk through
mentioned
the
that
numbers
before.
with you. Yep. And they can actually talk through the numbers as they are in comparison to what it would be if you did move it partially around. But the basic premise is that if the loan must be wholly or partially secured against the asset in order for us to be able to reduce the value of the asset.
Okay, well, look, I guess one of the, I always like to finish off on some key takeaways. So I think the key takeaways we've got is 20 March, big date. We've got a change in indexation. So people that are on a Services Australia pension are going to see an increase. First, just a little bit, but then when the next fortnight fully cuts in, they're going to get the full whack, which is great.
But also, with that increase, there's increase in the income cutoff points and the asset cutoff points. So there's going to be people who are eligible for a pension now who weren't eligible for a pension on the 19th of March.
Good point.
So again, go to the website. It will very clearly show you now what those new income and asset cutoff points are. Certainly, if you've got yourself a financial professional, they should be checking this
well on
anyway
top of it. Yeah, they'll be well on top of it.
But if you don't, then have a look, because it may well be that you weren't eligible, but you are. And if you are, lodge an application and start getting the pensions and the concessions that go with it.
That's great. And so, look, we've covered off a lot of territory today. We've talked about deeming rates, which, again, I figure from what I've heard, 0.25% and then 2.2% afterward, a certain limit appears. And I guess it's simplistic that way too. It makes working things out a lot easier for people, both for yourselves and for the pensioners themselves.
The thing I like about deeming, very quickly, is, as far as I'm concerned, from a Services Australia's perspective, it's the universal leveller. What I mean by that is it doesn't make any difference to the rate of pension that you're getting, whether you choose a share portfolio or managed fund to put the money in the bank account.
Excellent.
So I'm not using the pension as the reason for making those decisions. I'm looking at the investments themselves, what's good about them and bad about them, in making that decision, which I think is the most important thing.
Okay, we're just about out of time. Justin Bott from Services Australia. Always a pleasure to have you on the show. Incredibly informative, which is what Dollars Making Sense is all about. And until next time, Justin Bott, thank you very kindly.
Thank you so much for having me, Ray. It's always great to be here.